Welcome to Infinity Space. Let's look at part 4 and 5 of question number 3, case study question. So part 4 and 5 is relating to the consolidation. So what I did was all areas relating to financial reporting of the pre-scene and the pilot paper I have taken into one document. So because of that, before watching this video, you need to download that tutorial. In addition to that, I have done an introductory video with regard to the consolidation, explaining the adjustments in relation to consolidation, particularly relevant to this question. So you must watch that particular video as well before watching this video. And in the document what I have prepared, so I have included the requirement of the question or the part 4 and 5. If you look at the requirement at the very end of the question, so what it says is there are two requirements relating to the consolidation. One is part 4 to calculate the group gain or loss on disposal of small limited on 1st January 2019. So this question is to be prepared based on the Pinnacle PLC's consolidated financial statements for the year ended 31st December 2019. So here Pinnacle has disposed one of its subsidiary small limited on 1st January 2019, where you need to calculate the disposal profit in the group accounts. That is part 4. And if you look at the part 5, that is again relevant with the consolidation, you are requested to prepare the consolidated statement of profit or loss and the other comprehensive income and the statement of financial position of the Pinnacle group as at 31st December 2019, assuming that 25% interest in Teak PLC allowed Pinnacle PLC a significant influence over the financial and operating policy decisions of Teak PLC. So the part 5 it carries 22 marks. So the most important part in this question, where you are asked to prepare the consolidated income statement and other comprehensive income plus statement of financial position as at 31st December 2019, and it was mentioned that 25% interest held in Teak PLC to be considered as a investment in associate, because it was mentioned that so the Pinnacle has or Pinnacle had significant influence over the Teak PLC, which means it has to be accounted as a associate. So once we go through the question, I will explain about this in detail. Now by keeping the requirements in mind, if we read the question, right, so in this question what I did was certain numbers I have amended, slight amendments to ensure the arithmetic accuracy and also to make the figures more meaningful to the pre-scene as well as for the pilot paper. So the amendments what I have done, I will explain to you all once I go through the question. Right, if you look at the information given in the pre-scene, actually in the pre-scene you have been given the Pinnacle PLC's income statement and the statement of financial position information for the last 3 years. But you should remember for the consolidation, what is important for us is to prepare the income statement or the profit or loss and the other comprehensive income for the year ended 2019. So what is important is the 2019 numbers for the consolidation purpose. Right, by keeping that thing in mind, let's read the question. So the income statement of Pinnacle PLC for the year ended 31st December 2019, 18 and 17 were given. So the all figures are in rupees millions. First of all, sales 150,738, then cost of sales 109,285. I am reading only the 2019 figures. Gross profit 41,453, operating expenses 37,178, profit from the operations 4,275. Then there is another income, so which is only in the year 2019, so 3,800. Then other expenses and losses 2,582, profit before tax 5,493, income tax 883, profit for the year 4,610. Then in addition to the profit for the year, there are two other comprehensive income items as well here. One is gain on property revaluation 300 and investment in equity interest in Teak PLC. Okay, it seems that Pinnacle fair value the investment in the Teak PLC. Okay, and the fair value gains and the losses are recognized in the other comprehensive income. That is at the individual financial statements of the Pinnacle PLC. Okay, in the individual financial statements of the Pinnacle PLC, so the Pinnacle fair value the investment in Teak, okay, and the fair value gains and losses are recognized in the other comprehensive income. Then the total comprehensive income, that is this profit figure plus 2 items in the other comprehensive income, total comprehensive income comes to 5,465. Then you have been given the earnings per share figure as well, 4.61. Moving on, then on the next page you have been given the Pinnacle PLC statement of financial position. So in this question you are requested to prepare income statement and OCI plus statement of financial position, again as at 31st December 2019. So here also in the question you have been given the numbers for the 3 years, but what is important for the consolidation is the figures relevant to 2019. Now if I read the figures relevant to 2019, non-current assets, under that you have property, plant and equipment 58,459, then investment in Teak PLC 7,020. So this is one of the amendment that I have made. The amendment in the sense, in the question there was some other name instead of Teak PLC, that's wrong. So I made it to Teak PLC, which is the associate initially, and then it would become a subsidiary actually to the Pinnacle PLC. So you have to make that correction in the pilot paper. It has to be the investment in Teak PLC 7,020, then the investment in Small Limited. You see, Small Limited, there was a investment in 2018, but in the financial statement or the statement of financial position as at 31st December 2019, there is no investment in Small Limited, because if you can remember the requirement of the part 4, it was clearly mentioned Small Limited's entire holding was disposed by Pinnacle PLC as at 1st January 2019, at the very beginning of the current financial year, 1st January 2019 itself, the investment in the Small Limited was disposed. Okay, so that's why at the year end there is no investment relevant to the Small Limited. So, and also the other thing that you remember is you are not going to consolidate any income or the expenses of the Small Limited, because as it has been disposed at the first day of the financial year. Otherwise, if it is disposed maybe after 3 months from the starting of the financial year, you have to time apportion the Small Limited's numbers and add the income and the expenses to the consolidated profit or loss statement. But here it's not required, because Small Limited was disposed at the very first day of the current financial year, that is for the year ended 31st December 2019. Then after the current assets you have after the non-current assets you have current assets. Under that, first one is inventory 32,236, then trade receivable 13,042, right, then other current assets 172, cash and cash equivalents 53,171. Then the total value of the assets, both non-current and current, in 2019 118,650. Moving to the equity section. So the stated capital, that is ordinary shares 16,718, retained earnings 46,245. Then other components of equity. In the question, in the pre-scene it was mentioned as other reserves, but the correct name is other components of equity. I have mentioned that as other components of equity, and also what it was given here as the figure is 853, but I made it to 1853 because to make the figures more meaningful. Once we discuss the answer, I will explain about what is the adjustment required for the other components of equity. So I have taken it as 1853 instead of 853 what is given in the question. Then non-current liabilities, under that you have long-term debt 24,420. Then after that what you have is the current liabilities, trade payable 11,970. Again in the question this was given as 12,970, but to make the balance sheet balanced, what I made was, because I have increased the value of the other components of equity by 1,000, so because of that I had to reduce the trade payable balance what is given in the question by 1,000, so I made it to 11,970, right. All these small amendments have been done to make the figures more meaningful, right, to the question. Then current portion of the long term debt, so which means if you look at the long term debt, so you have a balance of 24,420 under the non-current liabilities, and under the current liabilities 15,376. This is actually out of the total long term debt, long term liabilities, how much to be paid in the next financial year. amount to be paid in the case of this long term debt in the next financial year, you include under the current liabilities. Then other current liabilities 2068, and the total current liabilities, that is the total of trade payable, current portion of long term debt, and the other current liabilities comes to 29,414. So ultimately total equity and liabilities 118,650. So this is about the balance sheet of the parent company. Okay. And two other information were given in the pre-scene with regard to this question, consolidation question, that is so on 1st January 2018, okay, that is 2 years ago from the reporting date, because reporting date is 31st December 2019. Okay, so 1st January 2018 means 2 years ago. Pinnacle bought 100% of the voting share capital of Small Limited on its incorporation. For 1,600 million, Small Limited is a transportation solution provider using specially designed apps. So here it is 100% acquisition, that means there is no non-controlling interest, and also it was acquired at the time of the incorporation. So if parent acquire a company at the time of incorporation, there is no goodwill figure. So goodwill comes if the parent acquire an ongoing company, running company, because for the good name that the company has generated by being in the business for several years, you have to pay a premium, that is goodwill. But here if you acquire a company at the incorporation, normally there won't be any goodwill figure, right? Then part B, or the second information what it was given in the pre-scene relevant to consolidation is 31st December 2017. Again here I made an amendment because in the pre-scene it was mentioned as 31st December 2018. But to make the figures more meaningful, I made it to 31st December 2017. Okay, that is yet again 2 years before when it comes the current reporting date, because reporting date for this year end is 31st December 2019. 31st December 2017, Pinnacle PLC acquired 25% of Teak PLC for 2020 million, when the TP means Teak PLC's, TP's reserves standing at 5,800 million. Fair value of TP's identifiable assets and the liabilities at that date was 7,400 million. So what has happened was 31st December 2017, Pinnacle acquired 25% of Teak PLC. And hope you can remember the requirement of the question. Part 5 says that it is to be assumed that by acquiring 25%, Pinnacle has the significant influence over the Teak PLC. That means as long as Pinnacle has this 25%, Pinnacle has to account the investment in Teak PLC as investment in associate. So the Pinnacle has to follow the equity accounting, right? So the equity accounting means in the statement of financial position, cost plus share of post-acquisition net asset increase. What is the share? 25% of post-acquisition net asset increase. In the income statement, equity accounting means one line item where you take the share of associate profit. Share means again 25% of associate profit. Again, if the associate is having any other comprehensive income items, so you have to take 25% of those other comprehensive income items as well, as long as Teak is to be considered as an associate to the Pinnacle PLC. And so the reserve balance at the date where this 25% acquisition was made was at 5,800 million, and the identifiable net assets were 7,400. Again in the question this figure 7,400 was given as 7,200. I made a small amendment again to make the figures more meaningful, 7,400 million. Then both the Pinnacle and the Teak PLCs are stock market listed companies. Both these two companies are listed companies. Teak PLC is providing tech and IT support for the manufacturing businesses. So this is what is given with regard to the financial reporting area in the pre-scene, right? So I have taken these areas separately because then it's easy for me to explain to you all this question. Okay. Right, now let's move to the unseen. Unseen means what is given in the pilot paper. So there also I made few amendments to the numbers. I'll explain about those when I go through. right? So, information given in the pilot paper, first of all, first information is about the disposal of small limited. As per the part 4 of the question, it was mentioned 1st January 2019, small limited entire holding was what? Disposed. Now about that, 1st January 2019, Pinnacle PLC sold all of its holding in small limited for 5,400 million. So this is the sales proceed. As small limited is not a related business with Pinnacle PLC's core business, accordingly 3,800 million gain was recognized in the income statement of Pinnacle PLC. Now if you can remember, what was the acquisition price, or how much Pinnacle paid to acquire small limited? 1,600, and that was paid actually 1st January 2018, 1 year ago from 1st January 2019, and it was disposed after 1 year for 5,400, which means the difference between 1,600 and 5,400, so the purchase price and the disposed price, Pinnacle has taken into the Pinnacle's individual separate financial statements. Okay, accordingly a gain of 3,800 million was recognized in the income statement of Pinnacle PLC. So if you again look at the Pinnacle PLC's income statement, under the other income there is a figure of how much? 3,800. That is this disposal, right? So in my introductory video I mentioned that when parent disposes a subsidiary, if the control is lost, what parent normally does is parent record the profit in their individual financial statement that they calculate by comparing the sales proceed and the carrying value of the investment. So in this question 5,400, and so the sales proceed is 5,400, carrying value or the cost of the investment is 1,600. So the profit is 3,800, that was recognized in the Pinnacle's individual financial statements. But when it comes to the consolidation purpose, I clearly mentioned to you all, so you can't take the individual parent's profit. Okay, you have to remove that and you need to calculate the profit as per the consolidated financial statement. And the format of calculating the profit in the consolidated financial statements, again I discussed in my introduction video to the consolidation question. Okay, so anyway, once we go through or once we work out the numbers, we'll look at how to calculate the gain on the disposal in the consolidated accounts. Then the statement of financial position of the small limited as at 31st December 2018, at the end of the last year, because it was disposed on very next day, 1st January 2019. So you have been given the statement of financial position of small limited as at 31st December 2018. So under that you have non-current asset 4,000, then current asset 1,000, so the total asset value is 5,000. Then equity, share capital, so basically ordinary shares 1,600, retained earnings 2,400, current liabilities 1,000, total equity and liabilities 5,000. You see on the date of disposal, okay, on the date of disposal, if you look at the net asset value, okay, 31st December 2018 and thereafter 1st January 2019, what is the total net asset value? 1,600, that is share capital plus the retained earnings 2,400, altogether 4,000. Because when you calculate the disposal profit in the group accounts, important information is what is the subsidiary's net assets at the date of disposal, which is how much? 4,000. Right, moving on. Then you have been given additional information in the pilot paper, so as an unseen information about the increase in investment at Teak PLC, because at the pre-scene what it was given is Pinnacle acquired 25% holding of Teak PLC as at 31st December 2017. Now additional information about the increase in investment in Teak PLC. As a part of expansion strategy of Pinnacle PLC, the board of directors decided to increase the investment in Teak PLC. This is important. On 30th September 2019, that means during the current financial year after 9 months. 30th September 2019, during the current financial year after 9 months, further 35% stake in Teak PLC was acquired for 4,025 million, giving Pinnacle PLC control over the Teak PLC. So what is this step acquisition? Parent acquire the control, parent achieve the control over a subsidiary in stages. 31st December 2017, 25%. 30th September 2019, another 35%, altogether 60%. So then you have to apply the accounting rules what we learned in the case of step acquisition. Again, in my introduction video, what I did was I have explained to you all the rules relevant to the step acquisition. So again, when we look at the numbers, when we actually work out the numbers, we look at what to do with this step acquisition scenario. Then and also one more information, for 9 months of the current financial year, Teak PLC is a what? Associate. You have to equity account during the first 9 months in the income statement as well as in the statement of financial position. Then on this date onwards, 30th September 2019 onwards, up until the year end, 31st December 2019, it has to be accounted as a subsidiary. You have to consolidate the income and the expenses of Teak PLC for 3 months. You have to time a portion and consolidate the income and the expenditure for 3 months. Okay, first 9 months it has to be equity accounted. Then fair value of Teak PLC's identifiable assets and the liabilities at that date was 9,400 million. Because when you acquire a subsidiary, it's a very important information that we need to have is what is the fair value of the net asset acquired. That is important for us to calculate the goodwill. Okay, so this is the opening net asset value in the consolidated balance sheet which Pinnacle prepares on 30th September 2019, including the Pinnacle plus the Teak PLC's assets and the liabilities. So the identifiable assets and the liabilities was 9,400 million. Then you have been given fair value of 25% holding, that is previously held equity investment, and 40% holding. What is 40% holding? Once parent achieves 60%, 40% of the subsidiary is held by whom? Non-controlling interest. So in this question, you have been given the fair value of that non-controlling interest as well. Might have been the non-controlling interest and the goodwill to be measured by using the fair value method. You have two methods, no? Proportionate net asset method and the fair value method. So you have been given the fair value mean most probably NCI and the goodwill to be calculated by using the fair value method. Anyway, let's read through. Fair value of 25% holding and 40% holding were 2,875 million, that is previously held equity investment of 25%. The fair value on 30th September 2019 is 2,875 and the 40% NCI fair value is 4,600 million respectively, and the Teak PLC's reserves stood at 7,800 million. So very vital information with regard to the achieving of control over the Teak PLC. Moving on, then two other important information is also given here. Pinnacle holds all investment in subsidiaries and associate at fair value through other comprehensive income in its separate financial statements as permitted by SLFRS 10 consolidated financial statements. I clearly mentioned in my introduction video, when parent prepare their individual or the separate financial statement to account the investment in subsidiaries, associates and the joint ventures in the separate financial statement, parent is having three choices. One is parent can account that at cost. Second choice, what is used here is account that as per SLFRS 9, measure it at fair value, and the fair value changes you can recognize in the other comprehensive income, or else in the profit or loss. In this case, value gains and the losses have been taken to the other comprehensive income. And the third choice is in the separate financial statements, parent can equity account the investment in subsidiaries, associates or the joint ventures. Remember here, parent company has used the second choice. But remember, when you prepare the consolidated financial statement, so when you fair value an investment in subsidiary, what is reflected on the parent's individual balance sheet with regard to this investment is the fair value at the reporting date, which is 31st December 2019 in this question. But for the consolidation purpose, remember, for the goodwill calculation, you have to take the purchase consideration as the fair value at the date of acquisition. Fair value at the date of acquisition, right? So if you have any fair value gains, what you have been recorded in the individual financial statements, you need to reverse when you take the numbers for the consolidation purpose. Again, this is very vital adjustment. So how to do that, we'll discuss once we work out the numbers in an Excel. Then moving on, 31st December 2019, fair value of Pinnacle PLC 60% holding in Teak PLC was 7020. This is what I have mentioned. In the individual financial statements of Pinnacle, 60% holding in Teak is fair valued as at 31st December 2019, 7020. This is the figure what is there in the Pinnacle's individual balance sheet. Okay. So the total cumulative gains recognized in the other comprehensive income of the Pinnacle PLC's separate financial statements amounted to 975. So this 7020 fair value reflects a cumulative gain recognized since the acquisition date. Initially acquired 25% and thereafter 30th September 2019 Pinnacle acquired another 35%. So since the date of initial acquisition of the 25% holding, that is as at 31st December 2017, from that date onwards to the reporting date, cumulative gain of 975 was recognized in the Pinnacle's individual financial statements. That means in the individual financial statements, investment would have been debited and this fair value increase should have been credited to the equity, other components of equity. This has to be included within the other components of equity. But remember, when it comes to the consolidation purpose, we have to reverse that fair value gain, okay, because the goodwill calculation has to be done, okay, by using the purchase considerations fair value at the date of acquisition, not at the reporting date. Okay, so we look at about how to do the adjustment again in detail once we work out the numbers. Then you have been given the summarized financial statements of Teak PLC for the year ended 31st December 2019. That is Teak PLC's statement of financial position and the statement of profit or loss and the other comprehensive income is also given, because you have to consolidate the Teak PLC, okay, with the Pinnacle PLC. Now first of all, balance sheet numbers or the statement of financial position figures have been given. Non-current assets, property, plant and equipment 7600. Then current assets, inventory 400, trade receivable 700, other current assets 350, cash and cash equivalents 750. Then total of inventory, trade receivable, other current assets, cash and cash equivalents, total is 2200. So adding that to the non-current assets, total asset value is 9800. Then moving to the equity section, stated capital, that is ordinary shares 800, reserves 7900, no non-current liabilities. Then under the current liabilities, trade payable 820, other current liabilities 280, altogether 1100, total equity and liabilities 9800. So you should be aware, you prepare the balance sheet, consolidation balance sheet as at 31st December 2019. So when you are preparing the consolidated balance sheet of Pinnacle PLC, what you need to do is you need to do the line by line addition of the assets and the liabilities of the Pinnacle PLC and the Teak PLC, because at the last date subsidiary was under the control of the parent. So we prepare the balance sheet as at 31st December 2019. On that date, parent controls the subsidiary. So you need to do the line by line addition of all the assets and all the liabilities of the parent as well as the subsidiary. Then finally, you have been given the information about the statement of profit or loss and the other comprehensive income of the Teak PLC. Here you need to be careful, because income statement is prepared for a period of time. Now Teak PLC was an associate in the first 9 months. You have to equity account in the first 9 months. You have to take the share of associate profit after tax in the first 9 months, share of associate other comprehensive income during the first 9 months. Last 3 months only you do the line by line addition. You have to time apportion the income and the expenses of the Teak PLC and add that to the consolidated income statement, add that to the consolidated other comprehensive income only in the last 3 months. Right. So the figures are given for the full year. Sales 800, cost of sales 380, gross profit is 420, operating expenses 20, profit from the operations 400, no other income, no finance cost, profit before tax 400, income tax 80, and profit for the year 320. Under the other comprehensive income, there is one item, that is gain on property revaluation 80. So the total comprehensive income 320 plus 80, 400. Then it's mentioned the difference between the fair value of identifiable assets of Teak PLC and its book value relates to value of a plot of land. The land has not been sold by 31st December 2019. I mentioned earlier, when parent acquires a subsidiary, at the date of acquisition you have to fair value the subsidiary's net assets. Okay, no, you can't take the carrying values as it is and add to the consolidated balance sheet. You have to fair value the net assets of the, net assets means assets and the liabilities of the subsidiary. In this case it's mentioned that, so normally what will happen is once you fair value, there are fair value gains. The fair values are higher than the carrying value at the date of acquisition in the subsidiary's books. So these fair value gains you have to record in the opening consolidated balance sheet. Here it's mentioned that if you have any fair value gain, so that has to be relevant with the land. Okay, so the land fair value has to be increased. So again, how to make the adjustment we'll look at once we do the numbers. Then finally, income and the expenses are assumed to accrue evenly throughout the year, because here first 9 months Teak PLC was an associate, in the last 3 months it was a subsidiary. So you have to take these numbers, especially the income statement and the other comprehensive income items, you have to time apportion when you are, because first 9 months equity accounting, last 3 months consolidation. Income and expenditure are assumed to be accrue evenly over the year. Neither company, that is Pinnacle PLC nor Teak PLC, paid dividends during the year. None of the companies have paid any dividends during the year. Pinnacle PLC elected to measure the non-controlling interest at the date of acquisition fair value. This is what I mentioned. So you have two approaches to measure the non-controlling interest and the goodwill figure. So fair value method, which includes, so within the goodwill, if you use the fair value method, it has parent's goodwill and the non-controlling interest goodwill. If you use the proportionate net asset method, within the goodwill you just have only parent's goodwill. So it is all about how do you measure the NCI. Here it's clearly mentioned, measure the NCI by using the fair value of NCI at acquisition. Hope you can remember, you have been given the 40% NCI fair value at the date of acquisition, which is on 30th September 2019 earlier. Then no impairment losses are recognized with regard to the goodwill. Okay, no impairment losses on recognized goodwill have been necessary today. No impairment losses in goodwill. So as I mentioned at the very beginning, two requirements are calculate the group gain or loss on disposal of small limited on 1st January 2019, at the very beginning of the current financial year. Group gain, consolidated gain, not the individual gain. Then part 5 is to prepare the consolidated statement of profit or loss and other comprehensive income. Okay, profit or loss and the other comprehensive income, and the statement of financial position of Pinnacle Group as at 31st December 2019. Assuming that 25% interest in Teak PLC allowed Pinnacle PLC a significant influence over the operating and the financial policy decisions of Teak PLC. So 25% investment to be considered as an associate, it has to be equity accounted. So in this question you are asked to prepare the statement of profit or loss and the statement of financial position together. So the approach that you need to follow is, you have to have the structure, statement of financial position, statement of profit or loss and other comprehensive income. Then you need to have the workings. So what are the workings to be done in the statement of financial position, what are the workings to be done in the statement of profit or loss and the other comprehensive income. Have your workings ready, and once you read the question, now you have an answer plan in your mind. So then when you attempt to the question. Now let's say when you are working out the question, take a particular item, take a particular adjustment. First of all, think what is the impact on the statement of financial position. In the statement of financial position, if there is any adjustment, make sure you pass both debit and the credit entry. Okay, so because statement of financial position means ultimately it has to be balanced. So for any adjustment, any entry, there should be a debit entry and the credit entry. Pass that entry. Then take the same adjustment, and see, okay, what is the impact of the adjustment to the profit or loss statement, OCI statement. If you have any impact to the profit or loss and OCI, make the adjustment. So what I am telling is, do it parallelly. First of all, take it and look at the impact on the statement of financial position. Then thereafter, same thing, consider the impact on the income statement. Sometimes the particular adjustment might not have an impact on the income statement. Okay, so the impact is only on the balance sheet. It can be other way around as well. Impact is only for the income statement. No adjustment is required on the balance sheet. Right? But what I am telling is, don't do the statement of financial position and the income statement separately. Then you waste your time, because in the exam time is very limited. Okay, so you have to complete the paper within 3 hours and 15 minutes. Okay, so how to do that with the formats, workings, and what are the other things that you need to remember when we work out a consolidation question, we will work out in Excel. Part 4 of the question requires us to calculate the group gain or loss on disposal of small limited as of 1st January 2019. So if you look at the information about the acquisition of small PLC and thereafter about the disposal, so I would say here part 4 of the question. So small PLC was acquired on 1st January 2018 as per the information given in pre-scene. So the Pinnacle bought 100% of the small PLC at its incorporation for 1,600. So I'll have that information first. Pinnacle acquired small limited on Pinnacle acquired 100% holding, 100% of small limited on 1st January 2018 for rupees 1,600 million. Okay, so Pinnacle acquired 100% holding of small limited on 1st January 2018 for 1,600. This is the date of incorporation of small limited. Okay, so then as per the information given in the pilot paper, right, so it was mentioned at the very beginning of my tutorial, 1st January 2019 Pinnacle sold entire holding of small limited for 5,400, right, as it's not a related business to the Pinnacle PLC. Now what has happened is, disposed entire 100% holding of small limited on, the date of disposal is important, 1st January 2019, what is the proceed for 5,400 rupees, 5,400, right. So this is very important to understand the date of disposal, because this has been disposed at the beginning of the financial year, which means the income and the expenses of small limited is not going to be consolidated when we are preparing the consolidated income statement. That is actually the next part of the question. Now what happened is, and also it's mentioned at the same place, Pinnacle has recognized 3,800 profit on the disposal of this subsidiary in its individual financial statements. That is simple and straightforward, because that is the difference between 5,400 and 1,600. So if you look at the income statement, okay, income statement of Pinnacle PLC, what is given in the pre-scene, under the other income 3,800 is recorded. This is the disposal profit in the individual financial statements. What we discussed was, when you are preparing the consolidated financial statement, you need to derecognize, you need to take out this disposal profit in the individual financial statements of the parent company, and instead of that you need to calculate the disposal profit in the consolidated income statement of the parent, and that has to be included into the consolidated income statement. So now the part 4 of the question requires us to calculate the gain on disposal at the consolidated income statement. So we discussed about the format of calculating the gain. So first of all, I am taking the disposal proceeds. So how much is the disposal proceed? As per the question, it's 5,400. 5,400 is the disposal proceed. Then I would say the fair value of retained interest. In this case, we don't have any retained interest because Pinnacle had 100% of small limited and entire 100% was disposed. That means there is nothing retained. So the retained interest value is 0. Then what you do is you take the total of these two. So the total of these two comes to 5,400. Then from that you deduct carrying value of the subsidiary, at disposal. You have to deduct this. So I would say this is less carrying value of the subsidiary at disposal. I told you all you need to derecognize 3 things with regard to the disposed subsidiary. One is net asset of the subsidiary at the disposal date, you need to derecognize. Then the goodwill figure of the disposed subsidiary, you need to derecognize. Similarly, if the subsidiary or if the particular subsidiary disposed is having a non-controlling interest, that also needs to be derecognized. Now the disposal was happened or taken place on 1st January 2019. On that date, first of all, I am taking the net assets at disposal. Net assets at disposal. Now again, in the pilot paper, you have been given the information or you have been given the balance sheet of Small Limited as at 31st December 2018. So as per the balance sheet, so the balance sheet date was 31st December 2018 and the subsidiary was disposed on the very next day. That means we can take the net asset value on 31st December 2018 as the net asset value on 1st January 2019. Now the net asset consists of equity items. So what are the equity items that the Small Limited is having is 1,600 share capital that was there at the incorporation itself, plus by carrying out the operation, Small Limited has generated retained earnings balance of 2,400. Altogether, then the net asset value is 1,600 plus 2,400. I would say it's 4,000. So the net asset at disposal, if I show the calculation here, 1,600 plus 2,400. 1,600 is the share capital, 2,400 is the retained earnings. So the net assets at disposal is equal to 4,000. Okay, 4,000. You have to derecognize the net assets. Then not only that, so the disposed subsidiary is goodwill to be derecognized, but in this situation you should understand there is no goodwill generated by acquiring the Small Limited, because Small Limited was acquired at its incorporation on 1st January 2018. So normally when a subsidiary was acquired at the incorporation, so there is no goodwill figure. So the goodwill figure is there if you acquire a subsidiary which is in the operation. Okay, so in this question there is no goodwill figure because it was clearly mentioned in the information what is given in the pre-scene. On 1st January 2018, Pinnacle bought 100% shares of Small Limited at its incorporation for 1,600, because the share capital also 1,600, which means there is no goodwill at the acquisition. So here for the completeness purpose, I will mention goodwill at disposal. There is no figure here, it's 0. Okay, goodwill is 0, no goodwill figure. Then you also need to derecognize that has to be actually deducted from the net asset value and the goodwill value, you need to also derecognize NCI of the disposed subsidiary at the date of disposal. NCI at disposal. Again, Pinnacle had 100% shareholding of Small Limited. If parent had 100% shareholding, that means there is no non-controlling interests. Okay, non-controlling interest means subsidiaries shareholders other than the parent. So if the parent is having 100%, there is no non-controlling interest in the Small Limited. So the non-controlling interest value also at the date of disposal will be 0. Then what you do is you take the net figure of these three numbers, and I am taking that to the final column. Actually, net assets at disposal 4,000 plus goodwill minus NCI at disposal. So the answer that I am getting here is I have to take the total of these three. I am taking that as a minus figure because I need to deduct that from the previous figure of 5,400. Okay. So 4,000 I need to deduct from 5,400. So the answer that I am getting here is 1,400. This is the profit on disposal in the group accounts of Pinnacle PLC. You see, the consolidated financial statements, disposal profit is 1,400, but in the individual financial statements, disposal profit was 3,800. When you are preparing, as I mentioned earlier, when you are preparing the consolidated income statement, what we need to do is we have to take out the individual financial statements profit, that is 3,800, and take the profit at the consolidated financial statement level. So with that, I answer to the part 4. Let's move to Roman number 5 of the question number 3. So this is the most important part where you are requested to prepare the consolidated statement of financial position and consolidated profit or loss and the other comprehensive income. So Pinnacle PLC consolidated statement of financial position, asset, December 2019. Okay, so you need to have enough space to prepare the consolidated statement of financial position, and by keeping enough space, so what we so once the question requires us to prepare two statements, both statements, statement of financial position and the profit or loss and OCI, what you can do is you can prepare both these statements together, right? Then you can save time. Otherwise what will happen is if you prepare one statement and then you need to prepare the other one, so it takes a lot of time. Okay, in the exam, time management is also very important. So what we can do is prepare both statements together. Now keep the space for the statement of financial position. I keep enough space here. Then I am having my, say, somewhere down the line here, Pinnacle PLC consolidated statement of profit or loss and other comprehensive income. For the year ended December 2019. Right. So then keep the statement for the statement of financial position and statement of profit or loss and the other comprehensive income. Then the workings. So workings are very important in any consolidation question. You know, when you prepare a consolidated statement of financial position, there are some mandatory workings which you need to do. So the mandatory workings are, the first working is the group structure, Then you need to have a net asset table for the subsidiary to identify the net asset value at the date of acquisition, at the date of reporting date, and the post-acquisition net assets of the subsidiary. Then working number 3 should be the goodwill calculation. Working number 4, non-controlling interest, and working number 5 is consolidated retained earnings. These 5 are mandatory workings for any consolidated statement of financial position. In addition to that, in this question, when I was reading the question, I figured it out. There is another reserve called other components of equity. So when you have reserves other than the retained earnings, you need to have a working for those as well. That means your working number 6 in this question will be consolidated other components of equity. And also in this question we have a associate, investment in an associate. Pinnacle's investment in Teak was considered as an associate initially. So in a statement of financial position question, when you have an associate, for that also you need to have a separate working. So that is actually then your working number 7. So what are the 7 workings that you need to have? 5 mandatory workings: group structure number 1, net asset table number 2, working number 3 goodwill, working number 4 non-controlling interest, working number 5 consolidated retained earnings, working number 6 consolidated other components of equity, as you have a separate reserve called other components of equity, and as you have an associate, you need to have investment in associate balance. For that also you need to do a working. So these are the 7 workings that you require for the balance sheet in this question. 5 mandatory workings plus 6 and 7 depending on the requirement. As you have an associate, working for an associate; as you have another reserve in addition to the retained earnings, additional working for that. So let's have the workings here. Working number 1, group structure. Keep enough space there. Then working number 2, net assets. Net assets of the subsidiary. Subsidiary in this question is Teak PLC. Okay. So for the subsidiary, I need to have 3 columns to find out the net assets. First of all, acquisition date. Acquisition date. Okay, what I can do is I can merge this. Okay, acquisition date. Then I need to have reporting date, and the third one is post acquisition. Post acquisition. Right. So these are the 3 columns which I require in the net asset table. Okay, these are the 3 columns which I require in the net asset table. So I will put up a small table there, so then it's easy for you to understand. Okay. Right. This is my net asset table, working number 2. Then working number 3 will be the goodwill calculation. Goodwill with regard to the acquisition of what? Teak PLC, yet again subsidiary. Working number 4, non-controlling interest. NCI, non-controlling interest, as at the balance sheet date. Then working number 5, consolidated retained earnings. And working number 6 would be Working number 6, consolidated other components of equity. Working number 7, investment in associate. Investment in associate. Okay. So when we are reading the question, we need to understand what type of workings that it requires. So you need to carefully read the question to understand this. So these are the workings that you require to prepare the statement of financial position. Then to prepare the statement of profit or loss and the other comprehensive income, what are the workings that you require? Again, you need to have a group structure, but in this case, you are not going to have a group structure because you already have the group structure. What I am telling is, if you are preparing the income statement only, you need to have a group structure. Then you need to have a working to allocate the profit to the non-controlling interest, because after deriving the group profit or the consolidated profit, what you do is you attribute that to equity holders of the parent and to the non-controlling interest. To find out how much of profit to be allocated to the non-controlling interest, you need to do a working. So the profit attributable to non-controlling interest from the during the year profit, consolidated profit, how much to be allocated to the NCI. Then again, as you have an associate here, you need to have a working in the consolidated income statement to find out the share of associate profit after tax during the year, how much of share of profit after tax that the associate has generated under the, because it has to be equity accounted. So for that even you need to have a working. So basically in the income statement, I need to have additional workings for the profit attributable to non-controlling interest and the share of profit after tax of the associate. I would name those as working number 8 and working number 9 in this question. Working number 8, let's say profit as well as total comprehensive income. In this case, subsidiaries having certain other comprehensive income items as well. So which means, so once you calculate the consolidated profit, once you calculate the consolidated total comprehensive income, both of these figures you need to allocate to the equity holders of the parent and to the NCI. So because of that, I'll name this working as profit and TCI. What is TCI? Total comprehensive income. Okay, attributable to NCI. Profit and the total comprehensive income attributable to NCI. And working number 9 will be, having a space, working number 9 will be share of associate profit after tax, PAT. PAT means profit after tax. So these are the workings that you require in this question. So I'll make them bold for the clear visibility, all these workings. Okay, right. I now have the structure to answer to the question. So I have the structure. So after having the structure, first thing that you need to do is you need to find out the group structure. Okay, so that is to complete the working number 1. So once you read in the question, we realize the group structure. So the group structure is, I am not going to rewrite about the small limited because I have already done the I have already shown the group structure in the case of the small PLC when I was doing the Roman number 4 or the part 4 of the question. So where it was acquired on 1st January 2018 100% and it was disposed on 1st January 2019 entire holding. Now you prepare the, so your year end or the financial year is financial year ended 31st December 2019. So which means with regard to the small limited, there is nothing to be consolidated during the current financial year as it has been already disposed at the very beginning of the financial year. Okay. So what I am going to write here is the information relating to the acquisition of Teak PLC. Now as per the information given in the pre-scene, right, so there it was mentioned, it's clearly mentioned in my tute. Okay, so I have separated the financial reporting part into a tutorial for the easy reference. So where you all can easily find out, okay, what are the information that you require to prepare this consolidated income statement. In that tutorial, the very last information under the pre-scene is, so it's mentioned B on 31st December 2017. I told you all to change the date. So what it's mentioned in the pre-scene is 2018, but it has to be corrected to 31st December 2017, right? Pinnacle acquired 25% of Teak PLC for 2020 million when the Teak PLC's reserves were standing at 5,800 million. So this is about the group structure. I would say Pinnacle acquired 25% of Teak PLC. Pinnacle acquired 25% of Teak on 31st December 2017 for rupees 2020 million. Okay. So on that date, reserves standing at 5,800 million. So on the same date, reserves means mainly the Teak PLCs should be the retained earnings, right? So what is mentioned in the balance sheet as reserves, so because of that I'll take the same word. Reserves were at that date 5,800. Then the fair value of the identifiable net assets, or the identifiable assets and the liabilities, which means identifiable net assets of Teak PLC on that date 7,400. Again, it was mentioned as 7,200 in the question, so I told you all to correct that as 7,400 million. Okay. So fair value of net assets. FV means fair value of net asset at the date where Pinnacle acquired 25% holding of Teak was rupees 7,400. Right. So that is about the initial acquisition of 25%. Then in addition to that, in the pilot paper, it was mentioned additional information under the increase in investment in Teak PLC. It was mentioned on as part of the expansion strategy. I am reading after the information given about the small limited in the pilot paper, you have been given the increase in investment in Teak PLC. As such, as per the expansion strategy of Pinnacle PLC, Board of Directors decided to increase the investment in Teak PLC. On 30th September 2019, that means during the current financial year, after 9 months of the current financial year, further 35% stake in Teak PLC was acquired for 4,025 million, giving Pinnacle PLC the control over Teak PLC. So this is what I mentioned about the step equation. Okay, so what happened is Pinnacle acquired additional 35% of Teak on 30th September 2020 for rupees 4,025. Okay, this is the equation of additional interest. So you see now it's a step equation because Pinnacle acquired the control over Teak in stages. Initially 25% and thereafter 35%. So you need to apply the equation accounting, or you should start doing the consolidation from 30th September 2019. It has to be corrected as 2019, right? Not 2019. Okay, so we discussed about how to apply the rules, what is mentioned in step equation. We'll do that, or we'll look that with the numbers once we actually do the question. Right. Then on that date, fair value of the identifiable assets and the liabilities of teak was 9,400 rupees in millions, and the, so we'll have that information as well. Fair value of the net assets, fair value of the net assets on that date, it's 9,400 million, right. Then fair value of 25%, that means previous holding. In step acquisition, we need to understand what is the fair value of the previous holding. So the previous holding was 25%, and the fair value of that 25% and 40% shareholding. 40% means now parent, after acquiring 35%, parent is having altogether 60%, which means 40% of the teak PLC subsidiary is held by the non-controlling interest. Now you have been given information about the fair value of the previous holding of 25% and the fair value of 40% of NCI at the acquisition date, because this is the date where you need to calculate the goodwill. This is the date where you need to initially start measuring your non-controlling interest. So this information is very important. So you take fair value of 25% stake. Value of 25% stake is equal to rupees, under the group structure you need to record everything, 2,875. Then the fair value of 40%, 40% means what? Non-controlling interest, 40% NCI is equal to 4,600. 4,600, right. Now, so this is what we have with regard to the group structure. Then it was mentioned that so the Pinnacle measure the subsidiaries at fair value through other comprehensive income. They select the choice of measuring the investment in subsidiary in the parent's individual financial statements at fair value through other comprehensive income. And also you have been given the fair value of this entire 60% holding as at 31st December 2019 in the individual financial statements of the Pinnacle PLC, which is 7,020 million rupees. So that particular information we will take once we actually do the numbers in the question. Okay, so once we actually prepare the balance sheet, we will take them into consideration. Right. About the group structure, actually this is what we need to have. Now what you can say is, in this particular scenario, for the first 9 months period, Pinnacle had 25% over teak, which means it has to be accounted as an associate. It's clearly mentioned that in the question, this 25% holding gives the significant influence over the teak PLC, which means it has to be accounted as an associate. You have to apply the equity accounting from 1st January 2019 to 30th September 2019 to account the teak PLC. Then after that date, so the holding in teak PLC has gone up to 60% by acquiring the additional 35%. From that date, it has to be accounted as a subsidiary. So when you are preparing the consolidated income statement, you have to time apportion the revenue and the expenses. First 9 months, it's an associate. Last 3 months, it's a subsidiary. But when you prepare the balance sheet, because balance sheet is prepared at a particular date, at the last date of the financial year, as at 31st December 2019. So as at 31st December 2019, it's a subsidiary. So on the balance sheet, you can consolidate. You can do the line by line addition of the assets and the liabilities. But in the income statement, you have to time apportion first 9 months equity accounting as it's an associate. Last 3 months, you have to consolidate as teak PLC is a subsidiary to the Pinnacle PLC. Right. By keeping those things in mind, now I can start putting the figures onto the relevant statement of financial position. So first of all, let's put the numbers to the statement of financial position. So I'll make the heading bold again. So first of all, starting from the non-current assets. Okay, starting from the non-current assets. So under the non-current asset, the first item is property, plant and equipment. I'll mention as PP&E, right? PP&E. So how much now, even though you have been given the numbers of year 2019, 18 and 17, what is important for us to prepare the consolidated financial statement is the numbers relating to 2019, right? So the property, plant and equipment of Pinnacle 58,459. To that you need to add the PP&E of the Teak PLC, which is 7,600. 7,600. You add 7,600. Right. Keep the account open. There can be adjustments. Okay. Then you have investment in Teak PLC. Investment in Teak. So how much is the value? 7,020. So subsidiary doesn't have any, that means Teak PLC doesn't have any investments, only Pinnacle is having the investment made in subsidiary. First of all, we'll take all the numbers to the face of the statement of financial position, and then we'll take them out, because this investment is required to, so this investment balance is required to be taken to the what? Goodwill calculation. So later on we'll take that. So first of all, we'll write down the figures into the relevant places. Then investment in small limited 0, because as I mentioned, entire investment of the small limited was disposed on 1st January 2019. There is nothing by the year end. Then before you write down the current assets, you should remember you need to keep a space for the what? Goodwill calculation. Goodwill of Teak PLC, because there will be a goodwill figure. So you need to keep a space that will be coming from working number 3 of the question. You need to keep a space, and also you need to keep a space normally for the investment in associate as well, but in this question you are not required to, because Teak PLC is no more an associate at the year end. Otherwise what will happen is, if you have the investment in associate also at the year end, for that even you need to keep a space before writing down the current asset. But in this question not required, because by the year end it has been disposed. Okay, by the year end it has been disposed, so because of that I am not going to keep any space. Okay, because by the year end Teak PLC is a subsidiary, not an associate. This is what you require for under the non-current assets. Okay, under the non-current assets this is what you require, but as a practice you can keep 1 or 2 lines space in the exam. Then if there's anything you can insert. Okay, so then let's move to the current assets. Current assets. So in consolidation, very simple, assets and the liabilities, what do we do is line by line addition. Okay, so parents assets and the subsidiary assets. Inventory 32,236 of the Pinnacle, and Teak inventory balance is 400. Inventory balance is 400. Then the next item is trade receivable. How much is the Pinnacle's? 13,042 plus Teak PLC subsidiary 700. Okay. Then other current assets, everything, all the assets, liabilities, line by line addition. Other current assets, $172 of the parent Pinnacle, Teak 350. Then cash and cash equivalents, Pinnacle is having cash and cash equivalents balance of 7,721, and Teak cash and cash equivalents are 750. Right. So these are the current assets that the two companies are having. Okay. Yet again, what you can do is you can keep 1 line space. If there's any additional thing we can include out of the adjustments, and also you have to have 1 column for the 1 row for the total, okay, to take the total balance as well. So then you start putting the equity figures, okay, equity and the liability numbers to the statement of financial position. Say starting from equity, so when you are putting the numbers in the equity section, you need to be careful because you can't do the line by line addition of the equity numbers, okay. So what you take is to the face of the statement of financial position, face of the consolidated statement of financial position, what you take is the parent's equity figures. Subsidiary equity figures you take to the net asset table that you do in working number 2. All the equity figures, all the net assets of the subsidiary is recorded in the working number 2, okay. Now how much is the share capital, stated capital of the parent? Parent stated capital comes to 16,718. Subsidiary equity capital, share capital is how much? 800, okay. Subsidiary equity capital, stated capital you take to the net asset table, working number 2, okay. All the equity items, share capital, reserves, whatever the reserves of the subsidiary, always take to the what? Net asset table. So thereafter, after putting the figures there, then we will take into the relevant places for the goodwill calculation, for the NCI, for the consolidated retained earnings. We will look at how to do that once we go through the question. Now what is given on the question is, now you have 3 columns here. Acquisition date, that means as per this question, acquisition date would be 30th September 2019. This is the date where you should start doing the consolidation, and this is the acquisition date of the subsidiary. This is the date where Teak has become a subsidiary of Pinnacle. Then the reporting date means 31st December 2019, that is the year end. Post acquisition means the difference between the reporting date and the acquisition date. What is the change in the reserves from the acquisition date to the reporting date? Now if you look at the stated capital, what is given in the question is the balance sheet of Teak PLC as at 31st December 2019. At that date, stated capital is how much? 800. Reporting date means 31st December 2019. At that date, stated capital is 800. Then what about the acquisition date? There is no mentioning about the share issue by Teak after 30th September 2019, so that we can consider the stated capital is same at the date of acquisition as well. So the acquisition date is, again I am reminding you all, 30th September 2019. Reporting date means 31st December 2019. If I put that for your reference on the top of the table, so this is 30th September 2019, this one 31st December 2019, okay. Then post acquisition means the difference between the acquisition date to the reporting date. Actually there is no difference. What I do is I take 800 reporting date figure minus the acquisition date figure. Actually there is nothing here. Post acquisition is 0, right. Then thereafter, after the stated capital, what do we have on the balance sheet? If I go back to the parent's balance sheet, Pinnacle's balance sheet, Pinnacle is having the retained earnings figure 46,245. Now I can take that to the face of the balance sheet straight away, but you know that when it comes to consolidation, lot of adjustments, consolidation adjustments are flown through the consolidated retained earnings, gone through the consolidated retained earnings. Because of that, what you do is, without doing these adjustments on the face of the consolidated statement of financial position, you do a separate working for the consolidated retained earnings, that is working number 5 here. So I can mention here with regard to Pinnacle, with regard to Pinnacle, what is the retained earnings as at 31st December 2019, that is taken to working number 5, 46,245, okay. That is the retained earnings of the parent entity. Then the retained earnings of the subsidiary you take to the what? Net asset table. Now in the net asset table, all the equity items of the subsidiary you take to the net asset table. So how much are the reserves of the subsidiary TEEC as at 31st December 2019, 7,900. I would say reserves. How much at the reporting date? 7,900. 7,900. Okay. Then how much is the reserves at the acquisition date? If you look at this question, right, this is the acquisition date, 30th September 2019 is the acquisition date. That is the date we are going to apply the acquisition accounting. So how much were the retained earnings balance on that date? So you have been given the fair value of the net assets 9,400, you have been given the fair value of the 25% holding, you have been given the fair value of the 40% holding. You should have been given in the question the reserve balance on the same date. Yeah, I missed that figure. I am now including that figure here. I will insert a line here in between. A second, I will insert. Yeah, I will insert a line and include that figure because that information is very important, right? So that's happened, right? So once you go through the question, if you miss something, always insert that into the relevant place, right? So reserves as per the question. So this is actually there in the pilot paper under the increase in the investment of TEEC PLC. So the last line says that reserves stood at 7,800. So the reserve balance on that date 7,800. 7,800. I'll make it as rupees million. Right. Okay. So the reserve balance as at the date of acquisition was 7,800. Right, 7,800. Reporting date figure is taken from the statement of financial position of TEEC as at 31st December 2019, which is 7,900. Acquisition date figure was given from the information what's there in the pilot paper under the increase in investment in TEEC PLC, which was 7,800. That means what is the post acquisition? From acquisition date to the reporting date, reserves have gone up by how much? 100. 7,900 minus 7,800. Yeah. You understood up to now, right? So basically what we did was parents share capital we have taken to the face of the consolidated balance sheet. Subsidiary share capital we have taken to the net asset table. Then the parents retained earnings we have taken to the working number 5 over here, Pinnacle. Then the subsidiary retained earnings, so the subsidiary reserves we have taken to the net asset table, acquisition date and the reporting date. Right, going back to the question, parent is having a one more reserve called other components of equity, and I told you all that so the figure what is given in the question is 853, but to correct or to ensure the accuracy I made the change it to 1853. Okay, so what I'm going to take here is 1853. Okay, so with regard to the working number 6, consolidated other components of equity, I'm taking the figure with regard to Pinnacle. Pinnacle's figure is how much? 1853. Okay. There are some figures which I had to change, right, because of to make sure the arithmetics are correct. So it is 1853, but what it was mentioned in the question is 853, but I made it to 1853. So in my tute it's clearly mentioned. Okay. Right. So that is parents other components of equity, because if any reserve is there in the parents books, what you do is you do additional working. You see, consolidated retained earnings, you have taken the parents retained earnings. Consolidated other components of equity, we have taken the parents other components of equity. For any reserve of the parent entity, do a separate working. Okay. Right. Then that's it with regard to the equity section. Then before moving to the liabilities, you know, when preparing the consolidated statement of financial position, what I need to do is I have to keep the space under the equity section for the reserves, consolidated retained earnings. I'm keeping a space. I would say this is coming from working number 5. Then I need to keep a space for consolidated other components of equity. This is coming from working number 6, right? And also you have to keep a space for the non-controlling interest, because non-controlling interest is also an equity section, that is subsidiaries, equity holders other than the parent, that is also part of equity. Okay, so non-controlling interest balance as at the reporting date you are getting from working number 4. Okay, so once we complete these workings, we can easily take the numbers into the relevant places. So keep the space for the reserves and the non-controlling interest. Then what I can do is I can move on to the non-current liabilities, right? Non-current liabilities. Non-current liabilities. In the case of the liabilities, similar to the assets, what I need to do is line by line addition. Okay, do the line by line addition. So parents non-current liability, long term debt, how much is the long term debt? 24,420. So is subsidiary having any long term debt? No, 0. Okay, there's nothing with regard to subsidiary. Then you take the current liabilities. Okay, again what you need to do is the line by line addition of the parents and the subsidiary figures. Trade payable, parents 11,970, right? I amend the figure, it was mentioned as 12,970, but I changed the figure to 11,970 in the tute what I have prepared, right? 11,970 plus subsidiary is having a trade payable balance of 820. Okay, line by line addition, that means TEAC. Thereafter, so the current portion of the long term debt, so the long term debt, the amount to be paid in the next year, that is shown under the current liabilities. Current portion of long term debt, which is how much? Parent is having a figure of 15,376. Again, TEAC subsidiary doesn't have any current portion of long term debt. Finally, other current liabilities. Pinnacle is having a balance of 2,068 and subsidiary TEAC is having other current liabilities of 280. Line by line addition. Okay, right. Now the balance sheet, I have written down the assets, liabilities and the equity into the relevant places, because I know the group structure. If I know the group structure, I can put the figures into the relevant places. I haven't made any adjustments yet. Before moving to the adjustments, let me complete the income statement as well. So in the income statement, I told you all what you need to consolidate is only the last 3 months. First 9 months you have to equity account because it's an associate. Okay, TEAC is an associate in the first 9 months. You consolidate, you do the line by line addition only in the last 3 months. So you have to time apportion the figures, right? So if you look at the parents figures, again in the income statement, even though numbers for 3 years are given for the consolidation purpose, what is important for us is the numbers for the year ended 31st December 2019, right? So this is Pinnacle PLC. Consolidated statement of profit or loss and the other comprehensive income for the year ended 31st December 2019. So I am taking from sales here. Sales 150,738 plus subsidiary is having a sales figure of 800. Okay, 800. Okay, 800, but I need to take 800 into 3 upon 12. Okay, because I consolidate the subsidiary only in the last 3 months. Acquisition date is 30th September 2019. all the figures of the subsidiary I have to time apportion. Then the next one is cost of sales. How much? 109,285, that is parents, plus subsidiary cost of sales 380, again 380 into 3 upon 12. I consolidate only for the last 3 months. Okay, right. So then I need to have my gross profit figure. Okay, I need to have my gross profit figure, right? And after the gross profit, operating expenses. They are again I am taking the parents figure 37,178 plus, that is Pinnacles, then Teaks 20. Okay, 20 into 3 upon 12, 20 into 3 upon 12, last 3 months. Then I am taking profit from operations, profit from operations. After that, other income, parent is having 3,800 worth of other income. What is this? Hope you can remember, this is the individual financial statement profit of the parent company. In the parent's individual financial statements, the profit of disposing the small limited, so which we need to eliminate when it comes to the consolidation level. That should be the first adjustment, keep that in mind. Okay, we'll do that. Then subsidiary doesn't have any other income. Similarly, after that what you have is other expenses and the losses. Okay, after other income, the next item is other expenses. Okay, and losses. Parent is having 2,528 figure, and subsidiary doesn't have any other expenses. Okay, 0. Only parent is having the numbers. Then before you write the profit before tax figure, now you need to keep in your mind, that's why when you are reading the question, you need to understand, you need to plan your answer. You have to keep a space for what? Share of profit after tax of the associate, because TEAC is equity accounted in the first 9 months, during the first 9 months. So out of that you will be having a figure called share of profit after tax. For that I need to keep a space before I write down the profit before tax. Okay, so that figure actually we derive out of the working number 9 here, share of associate profit after tax. Okay, so I would say here share of associate profit after tax. I'll be getting that figure from working number 9. And also you need to include the gain in the Pinnacle's consolidated profit or loss with regard to the disposal of small limited. So in the previous part we have calculated the disposal profit in the parent's individual financial statements. Sorry, parent's consolidated financial statements. So what is the parent's consolidated financial statement profit of disposing the small limited? 1,400. That also to be included into the consolidated income statement. What you can do is you can show that as a separate line item if you require, or else this figure can be included into the other income. So I am not going to keep a separate line here because I am going to include this under the other income. Okay, right. Okay, then I can have my profit before tax figure, profit before tax. After profit before tax, income tax expense. Parent is having an income tax expense of 883 plus subsidiary income tax expense 80. That also you need to time apportion 80 into 3 upon 12, last 3 months only. Then profit for the year. Profit for the year, right? Then that is the profit or loss statement. And also you have here other comprehensive income. After deriving the profit for the year, I need to then have other comprehensive income. I need to have other comprehensive income. Okay. Under that, I am having actually two items. One is gain on property revaluation. Okay, gain on that also I need to do the line by line addition. Parents plus subsidiary numbers. Okay, similar to the income and the expenses, OCI items, other comprehensive income items are also line by line added. Gain on property valuation. This is revaluation gain. Okay, property valuation. Parent is having a figure of 300. Subsidiary is also having a figure of 80. Again, time apportion 80 into 3 upon 12. 80 into 3 upon 12. You consolidate only last 3 months. Right? Then thereafter, there's a figure investment in equity. Equity instrument. This is actually the fair value gain. If I put the correct name here, fair value gain of investment in equity instrument. So it was mentioned in the question, in the individual or the separate financial statement of the parent account the investment in subsidiaries at fair value, and the fair value gains and the losses are taken to the other comprehensive income. So during the year, by fair valuing the investment in subsidiaries, the TIC PLC current year fair value gain is how much? 555. 555. And subsidiary doesn't have any fair value gains of equity instruments. Then I can say that total other comprehensive income. The total of these two items, I would say total other comprehensive income. Total other comprehensive income. Even though in the question there is no separate line item, I recommend you all to have a subtotal for the total of the other comprehensive income, right? Then finally, you will be having the total comprehensive income, that is the aggregate value of the profit for the year and the total other comprehensive income. Okay, total comprehensive income. That is the aggregate value of the profit for the year plus total other comprehensive income, right? Then what you need to do is both profit for the year, these are the important totals, so you have to take the total comprehensive income. Similarly here you need to take the what? Total profit for the year. Okay, you have to take the total profit for the year. Now this profit for the year and the total comprehensive income, okay, so both you need to attribute to the two parties. Who are the two parties? Equity holders of the parent, that is the parent's shareholders, and to the what? Non-controlling interest. So in my consolidated statement of profit or loss and the other comprehensive income, the last section is, I would say, profit for the year attributable to two parties. First of all, equity holders of the parent, and non-controlling interest. So you remember working number 8, profit out of the consolidated profit, how much it is attributable to NCI is taken from working number 8. So here the figure I am getting from working number 8. Okay, profit attributable to NCI from working number 8. During the total profit of the group, how much it is to be allocated to the NCI. Similarly, total comprehensive income also I need to attribute to the equity holders of the parent and to the NCI. So the final figure is total comprehensive income attributable to two parties, equity holders of the parent and non-controlling interest. Again, total comprehensive income attributable to non-controlling interest also you derive from working number 8. You derive this figure also working number 8. So that's the importance of having the workings properly. Then you can easily take the numbers. Right, so we have put the figure or the information into the relevant section. Now the next and the most important part is moving on to the adjustments. First adjustment that we need to do is, now in the individual financial statements, parent accounted the investment in subsidiary at fair value and it was measured at fair value through OCI. When you were discussing the introductory session, I mentioned that actually parent has three choices in the individual accounts. Parent can account the investment in subsidiaries at cost, parent can apply SLFRS 9 and fair value, and the fair value changes can be taken to the other comprehensive income or to the P&L, or else parent can equity account in the individual financial statements. So in this question, parent has accounted this as per SLFRS 9 fair value, and the fair value changes have been taken to the other comprehensive income. But when parent is preparing the consolidated financial statements, so these fair value gains and the losses what you have recorded in the individual financial statements needs to be removed. So as per the question, so before the statement of financial position of the TEEC PLC in the pilot paper, it was mentioned the para before the statement of financial position of TEEC PLC as at 31st December 2019, fair value of Pinnacle's PLC's 60% holding in TEEC was 7,020 million. Within brackets, and the total cumulative gain recognized in the other comprehensive income in the Pinnacle PLC's separate financial statements amounted to 975 million. So this has to be reversed when parent is preparing the consolidated financial statements, because this has to be, the investment in subsidiary has to be part of the goodwill calculation. When you take into the goodwill calculation, you have to take the investment at the date of acquisition fair value, not the reporting date fair value. What is recorded on the Pinnacle's individual financial statements is the reporting date fair value of the investment in subsidiary. But for the consolidation purpose, you have to take the fair value of the purchase consideration at the date of acquisition, which is equal to the cost of the investment at the date of acquisition. So the cumulative gain recognized in equity you need to reverse in the statement of financial position. Right. So this gain would have been debited to the investment in TEEC within this 7,020. The gain of 975 is included. What we need to do is we need to remove this fair value gain, cumulative fair value gain. Remember, when you are making an adjustment in the statement of financial position, you need to ensure that you pass both debit entry as well as the credit entry. Otherwise, your balance sheet or the statement of financial position is not balanced. So ensure all adjustment consist of debit and credit, okay, in the balance sheet. Now what you do is you deduct 975 here, that is the credit entry, okay, and that has to be debited to the relevant reserve, because this fair value gain of the equity investments should have been included within the other components of equity of the parent within this 1,853. So that has to be deducted. Deducted means this is a credit balance, deducted means this has to be debited. So you can say cumulative fair value gain, cumulative fair value gain of equity instrument, equity instrument, that is TEEC. So you have to deduct, deduct means debit minus 975, minus 975. Okay, I will make them a second. Okay, so I deducted 975, that means debit 975. Okay, so similarly it was credited to the investment in T, credit 975. I can say what it is, because always make Marcus life easy, right, giving the relevant references what you have done, then he can follow your workings. Fair value gain, you reverse the fair value gain. Okay, mention what it is. Credit 975 to the investment in Teak and debit 975 to the consolidated other components of equity. That is the balance sheet double entry. Then when you were preparing the consolidated profit or loss and the other comprehensive income, there even you looked at, you have this figure fair value gain of investment in the equity instrument, that is in Teak, 555. That means out of this total cumulative gain of 975, current year gain is how much? 555, because as per the question, Teak was acquired by Pinnacle 31st December 2017, before 2 years. Now during the, so the cumulative gain includes, okay, cumulative gain includes the gain during the entire 2 years period, but in the current year other comprehensive income, what we have is the current year gain. So the current year gain is 555, that also you need to remove. Okay, that also you need to remove. So what I am going to do is this 555 I am going to take out from the consolidated statement of profit or loss and the other comprehensive income statement. So in the income statement you can't find the double entries, right, because income statement is not something which is getting balanced like balance sheet. You just need to remove that fair value gain of 555, but the double entry is passed on the balance sheet, right. That's the first adjustment. Here also you can mention what it is within the brackets, fair value gain you remove. Okay, you remove the fair value gain. Then the after removing this fair value gain, we need to account the investment in Teak PLC. Initially the Teak PLC, if you look at the group structure, what has happened was 25% of Teak PLC was acquired on 31st December 2017 for 2020. Okay, so this investment is included in the balance sheet. Okay, this investment is included in the balance sheet. If you look at the balance sheet, the investment is included here, investment in Teak. So the initial investment is 2020. Thereafter, after period of time 30th September 2019, Pinnacle invested another 4025. If you look at the total of 2020 and 4025, what's the total there? 2020 plus 4025, so it comes to 6045. If you look at the investment value in Teak, what I am telling is the total of here 2020 25% investment value and the 35% investment value. So the total is 6045. If you look at the investment in Teak, so what is the balance after deducting this 975? That is 7020 minus 975. How much is the figure? 6045. So what is included here is the investment that Pinnacle made in Teak as at 31st December 2017, 2020 and as at 30th September 2019, 4025. What you need to do is, under the, this is a step equation, under the step equation I told you all clearly when I was having this introductory session about this question, up until you achieve the control as at 30th September 2019, you have to account this investment as per the relevant standard. Before you achieve the control, before you apply the acquisition accounting, this has to be accounted as an investment in associate. You need to follow the investment in associate accounting, that is equity accounting. Okay, so equity accounting means, right, so what I do is I am taking this investment, initial investment of 2020, out of this figure I am crediting 2020 here, I credit that and debit to the investment in associate account. Okay, credit 2020, I am taking the initial investment of 25% out of this investment figure and take that to the investment in associate here, working number 7. I would say cost, initial cost of acquiring 25% is initial cost of acquiring 25% is 2020. Right. So again the double entry here, debit here, investment in associate, credit to the where? Individual balance sheet investment value in TEEC, credit 2020 and debit 2020 here. Okay. After taking the initial cost, then you need to take the share of post acquisition reserve increase of the associate, that is equity accounting. Right. So the initial 25% was acquired on 31st December 2017, where the reserve balance was 5,800. Then up until 30th September 2019, where on that date the control was achieved, where you need to apply the acquisition accounting. So up to that you need to follow the equity accounting. So which means the reserve as at 30th September 2019 is 7,800. So the increase is from 5,800 to 7,800. So the reserve increase in between these two dates are 2,000, 5,800 and 7,800. Out of that, 25% you need to include in the investment in associate value. Okay. So the what we do here is go to the investment in associate and you can say share of post acquisition reserves, associate share. So the total reserve increase 30th September 2019 it is 7,800, 31st December 2017 5,800. So the increase is 2,000. Out of that 25% belongs to the Pinnacle. Okay. So which means the value would be, if I do it, 7,800 minus 5,800 into 25%, that comes to 500. So yet again the double entries, it is debited to the investment in associate and credited to the consolidated retained earnings. So I can say consolidated retained earnings, share of post acquisition reserves of associate. So how much you can take the same value what you have taken here, 500. Okay. So the double entry on the balance sheet, debit entry goes to the investment in associate, working number 7, credit entry goes to the consolidated retained earnings. Right. That is the balance sheet treatment. What about the, even in the income statement, what you need to do is you have to equity account the investment in TEEC up to 30th September 2019. First 9 months it has to be equity accounted. Now if you look at the consolidated statement of profit or loss and the other comprehensive income, I have kept a line here, share of associate profit after tax, working number 9. If you go to the working number 9, I can now complete working number 9. So what I need to do is, if I go back to the income statement of TEEC or the profit or loss and the other comprehensive income of TEEC, so what is the total profit for the year? 320. That is for the entire 12 months period. Out of that 9 months you have to equity account. So in the income statement with regard to the associate, you have only one line item saying share of profit after tax. Okay. So how much that you need to include here is, so the total profit after tax is 320. So TEEC is an associate only for how many months? First 9 months. So I need to take out of this 9 upon 12, that is 9 months profit, into what is the share that the parent or the Pinnacle had over TEEC, 25%. Okay. 320 is the total profit after tax out of that first 9 months, and first 9 months profit into 25%. So the value is, I would say, 320 into 9 divided by 12 into 25%. How much? 60. Okay. Share of associate profit after tax 60. You can take this into the what? Consolidated income statement here. Consolidated income statement, working number 9, share of profit after tax of the associate. I can give the reference 60. Okay. And also not only that, actually with regard to Teak PLC, you have other comprehensive income item as well. That means out of the other comprehensive income also you need to allocate share of the other comprehensive income of the associate to the consolidated income statement, because if you look at the Teak PLC, there are other comprehensive income, there's a gain on property revaluation 80. Out of this 80, relevant amount for the 9 months. So that means 80 into 9 upon 12. So out of that 25% you need to allocate to Pinnacle. So actually here under the other comprehensive income I need to have another line item, because like share of profit after tax, you need to take the share of other comprehensive income also with regard to the associate. So what I do is, as I haven't kept any space, right, so I insert, what I do here is I insert a line here, right, I can insert a line here. Okay, I'll take one more line item here saying share of associate other comprehensive income, OCI, share of associate OCI. Earlier share of associate profit after tax. I'll take the figure from working number 9 itself. Okay, I'll take the figure from working number 9 itself, or else I can do additional working, but I'll take so let's take as working number 10. Working number 10 I would say. Okay, additional working, fine. So I have done up until working number 9. I can say working number 10, share of associate other comprehensive income. Share of associate other comprehensive income, additional working, because in all questions you don't have this working, right? So in this case, why do you need to allocate share of associate other comprehensive income to Pinnacle PLC? Because Teak PLC is having a OCI balance, other comprehensive income item, revaluation gain. Out of that first 9 months gain into 25% you need to give to the Pinnacle. Okay, so how much? 8 is the total figure what is recorded in the Teak's other comprehensive income. Out of that first 9 months, that into 9 upon 12, once again 9 upon 12. Out of that how much? 25% to the parent company. So that comes to 80 into 9 upon 12 into 25%. How much? 15. So the share of associate other comprehensive income is 15. I can take the figure here. Okay, 15. Okay, did you understand? Very important adjustment, right? What I did up until now, if I summarize, so the Pinnacle acquired 25% of Teak on 31st December 2017 by paying 2020. This is the cost of investment in the associate. Okay, so that cost I have initially taken to the investment in associate balance 2020. So this is included actually in the balance sheet under the investment in Teak. I have taken that out from the investment in Teak, credit 2020 to the investment in Teak, and debit that balance to the investment in associate 2020. Then the up until Pinnacle achieved the control, it has to be equity accounted. That means control was achieved on 30th September 2019. Okay, so at that date actually the reserve balance was 7,800. Then the reserve balance at the date where the 25% was acquired, 5,800. So the reserves have gone up by 2,000. Out of this reserve increase, 25% is taken to the parent company. Okay, share of post acquisition reserve increase. So that is the balance sheet adjustment. So what I did for that was I debit that to the investment in associate, share of post acquisition reserves 2,000 into 25%, associates share of the investor. So 500 here, debit 500, to the working number 7, same 500 I have credited to the consolidated retained earnings because this is belongs to the parent company, right? That is the statement of financial position adjustment. Then even in the income statement you have to equity account the investment in Teak for 9 months. So what I did was, so in the income statement in working number 9, share of associate profit after tax, so I looked at the income statement of Teak where the profit for the year is 320. First 9 months you have to equity account that. So you have to time a portion 320 into first 9 months, 9 upon 12. Out of that 25% is taken to the consolidated profit or loss as share of associate profit after tax. Similarly, associate or the Teak PLC has other comprehensive income items. Out of that even first 9 months, 80 into first 9 months, 9 upon 12. Out of that 25% you need to take to the parent entities or the consolidated income statement as share of other comprehensive income of the associate during the first 9 months. So this 60 I have taken here, share of associate profit after tax, 60 before the profit before tax figure, and the associates share of other comprehensive income I have taken under the other comprehensive income items, 15. Okay. Then what will happen is, so now after taking the balance up to 30th September 2019, so now what is the balance here in the investment in associate account? 2520. Then from this date onwards you have to de-recognize the associate, because why? This investment in Teak would now become a subsidiary. You need to take the investment in associate out and you have to take this investment value 2520 into the goodwill calculation. This is the step acquisition. Step acquisition means on 30th September 2019, now Pinnacle acquire additional 35%. So the previously held equity interest, at the introductory video I mentioned that if you have any previously held equity interest, that has to be what? Fair valued. So this 2520 at the date of acquisition or on the date where the consolidation starts, you need to fair value and take that as a part of goodwill calculation. Okay, as a part of purchase consideration into the goodwill calculation. So what I am going to do is, I am going to take this out from here. That means I am going to de-recognize this investment in associate, because from here onwards there is no associate anymore, right? It would become a subsidiary. I can say de-recognition. This is de-recognition of associate, or else transfer this balance, transfer to purchase consideration. Okay, you can transfer this to the purchase consideration, or else you can mention this as de-recognition of associate. So minus 2520. Okay, you take that out. So credit here, and it is debited to the, as a part of purchase consideration means it is taken to the goodwill calculation. So in the goodwill calculation you can say purchase consideration. How much is the purchase consideration of this 25% holding? First of all, 2520. Did you understand the double entry? What did we do? Credit the investment in associate 2520, debit that to the goodwill calculation. This is the purchase consideration. Then we learn one more thing, that is, so on the date where you achieve the control, this previously held equity interest of 25%, you need to fair value. What is the fair value? What is the fair value? Here, fair value of that 25%, because equity accounted value is 2520, but for the consolidation you have to take the fair value of the previously held equity interest, so which is 2875 as per the information given in the question, which means this balance has to increase from 2520 to 2875. So what's the increase? 355 increase. So that increase you debit to the purchase consideration add 355 here, you would say this as a fair value gain, okay, debit that to the purchase consideration, credit that to the consolidated retained earnings. Actually this is recognized as a gain in the consolidated income statement. It is taken to the consolidated profit or loss. Through the consolidated profit or loss in the balance sheet, it is taken to the consolidated retained earnings. First of all, we will record the adjustment in the balance sheet, the double entry, then we will look at the impact to the income statement. Okay. So any adjustment in consolidation question, when you prepare the statement of financial position and the profit or loss and the OCI statement together, first of all think independently impact on the balance sheet. What is the double entry? Then thereafter take the impact of the same adjustment to the income statement. Sometimes there is an adjustment to the balance sheet as well as to the income statement. Certain entries affects only the balance sheet. Okay, right. So here balance sheet impact, you debit to the purchase consideration in the goodwill calculation, that has to be credited to the consolidated retained earnings. You can say fair value gain of 25%. How much? The value is 355. So that is the balance sheet double entry. Debit here purchase consideration, credit to the consolidated retained earnings. Then what will happen? Actually this gain of 355 has to be recognized through the consolidated income statement. You go to the consolidated income statement, and to this other income, what do? Is you add this 355. You add this 355. Again you can mention fair value gain of 25%. Value gain of 25%. Okay. Right. Okay. So now we adjusted that on the balance sheet as well as in the income statement. Then what we do is we'll calculate we'll take the other information that is required to calculate the goodwill. Now if I take the total here, 2520 plus 355 is 2875. That is the fair value of 25% holding on 30th September 2019 at the date of acquisition of the subsidiary. This is the date where you should start consolidation. Then you need to take the remaining 35% interest fair value. So how much is the purchase consideration paid to acquire the remaining 35%? So the Pinnacle acquired additional 35% of Teak on 30th September 2019 by paying 4025. So you can say purchase consideration of additional 35%. Okay, how much? Here 4025. 4025. Actually what happened is that is also included in the investment. Now this 4025 is also included within the what? Investment. So the double entry actually comes. What you need to do is you credit 4025 here, 4025 you credit the investment in Teak, okay, credit 4025 and debit that to the goodwill calculation. So you are taking the additional 35% investment balance into the goodwill calculation of Teak PLC. Now once you pass this entry 4025, now if you balance this investment in Teak account, what is the balance? It has to be, it is 0, it has to be 0. Okay, in the consolidated balance sheet you should not have any figure called investment in subsidiary. Okay, so the entire investment in subsidiary you have to take into the goodwill calculation. Now with this credit entry of 4025, there is no balance called investment in Teak or investment in subsidiary. What it appears on the consolidated balance sheet with regard to the investment in subsidiaries is the goodwill calculation. Okay, that will be taken from working number 3. Okay, so I have taken, so the double entry is taken, right? Credit 4025, debit 4025 to the goodwill calculation. Then now 25% and 35% parents holding is 60% in the subsidiary. Then 40% of the subsidiary is held by whom? Non-controlling interest. So what is the balance or what is the fair value of this 40% NCI at the date of acquisition 30th September 2019? 4600. That also I need to take into the goodwill calculation. I am taking that figure here, fair value of NCI at acquisition. How much? 4,600. Debit to the goodwill calculation, and this is the opening value of my NCI working. NCI working is working number 4. So I would say fair value of NCI at acquisition 4,600. Debit to the goodwill, credit to the NCI. Right. Then what I can do is I can take the total here. Okay, I can take the total here. What's the total? Total is 11,500. Then you have to compare this with the fair value of the net asset of the subsidiary at the date of acquisition. As per the question, what is the fair value of the net asset of the acquired subsidiary? 9,400. Then you need to take this additional information into account after the statement of profit or loss and the other comprehensive income of Teak PLC. You have been given an information. What is that? The difference between the fair value of identifiable assets and the liabilities of Teak PLC, and its book value relates to value of a plot of land. The land had not been sold by 31st December 2019. Okay. So what we need to understand here is the fair value of the net assets of the acquired subsidiary at the acquisition date 9,400. Now in this particular table, if I take the total, okay, so the total fair value of the net assets are to be how much? 9,400. So here it has to be 9,400. If there is a difference between the net asset value or these are the carrying values, what is recorded is the carrying value. Carrying value of the net asset is share capital 800, reserves 7,800. So what is the total? 8,600. But the fair value of the net assets are 9,400. You know, for the goodwill calculation purpose, when the parent acquire the control over a subsidiary, so what you need to do is, for the goodwill calculation purpose, you have to fair value the subsidiary's net assets at the date of acquisition. Then if there are any fair value adjustments, those fair value adjustments are to be incorporated into the opening consolidated balance sheet. In this case, there's a fair value adjustment. So for the difference between this fair value and the fair value of the net assets and the carrying value of the net asset, and as per the question, that is relating to the fair value adjustment of the land. So how much is the fair value adjustment? Then I can say fair value adjustment relating to the land. Land means PP&E. How much? The difference. I am taking 9,400. From that I deduct 800 and 7,800. So the balancing figure is the fair value adjustment land 800. Okay, so what is the double entry here? Credit the net asset table, and that has to be debited to the balance sheet or the statement of financial position PP&E value. So you debit 800 here. It is included into the opening consolidated balance sheet, fair value adjustment. So I would say fair value adjustment. Fair value adjustment relating to the land. Okay, debit 800 to the PP&E, credit 800 to the acquisition date net assets of the subsidiary. Then as per the question, land is not sold up until 31st December 2019. It is still there. That means this fair value adjustment is still there at the reporting date as well, because after subsidiary was acquired by the parent, subsequently you don't do any fair value adjustments. Okay, so only at the date of acquisition you calculate the fair value of the net assets of the subsidiary. Subsequently, thereafter, each reporting date you don't need to make any fair value adjustments, because this fair value adjustment is done to calculate the goodwill figure correctly. Okay, to calculate the goodwill figure correctly. So the goodwill is calculated at the date of acquisition. Okay. Right, so you have taken 800 to the reporting date column as well. That means post acquisition balance would be 800 minus 800, 0. Okay. Then I can take the total of the other two columns as well. Here 9,400, and what about the total of the reporting date? 9,500. So that is 800 plus 7,900 plus 800. Then the total of the post acquisition 100. You see the difference between the acquisition date and the reporting date. The total net asset 9,400 to 9,500. What is that? 100. Right. Now I am calculating the goodwill. For the goodwill calculation, what I am going to take is, I have taken the purchase consideration, that is 25 plus 35, then the fair value of NCI at acquisition. In the goodwill calculation, I compare this with the fair value of subsidiary net assets at acquisition. Fair value of subsidiaries net assets at acquisition. How much is the figure? I will deduct that. What is the figure here? I can link 9,400. I need to deduct 9,400. This is fair value, right? Not FV. Fair value of subsidiary net assets at acquisition. Then goodwill at acquisition. Goodwill at acquisition 11,500 minus 9,400. How much? 2,100. 2,100. Okay, there is no goodwill impairment. Okay, it is clearly mentioned in the last para of the paper, or in my tute, it was mentioned income and the expenses are accrued evenly throughout the year. So we have considered that neither company, that is Pinnacle or Teak, paid dividends, and Pinnacle PLC measure the NCI by using the fair value method. Okay, we have taken that also into consideration, because NCI is measured at fair value. You know, you can either measure the NCI by using the fair value method or the proportionate net asset method. Here by using the fair value method. Okay, so that is taken to the goodwill calculation as well as to the opening NCI value. Then the last point says that no impairment of goodwill have been recognized. That means goodwill at acquisition and the goodwill at reporting date would be same. So I can even take this into the balance sheet. Goodwill figure coming from working number 3, 2,100. 2,100. Are we clear? Right. So then, so this net asset table is very important, right? So the first column of the net asset table is for what? To calculate the goodwill. You have taken the purchase consideration 25% and 35%. Then you have taken the fair value of NCI. You have taken the total 11,500. From that, the total of the first column, acquisition date, net asset, fair value 9,400, you deduct and you derive the goodwill. So the net asset table is very important working to take the numbers in most of the workings relating to consolidation. So the next thing is, I can now complete my non-controlling interest and the retained earnings workings. So what should I do is, this post acquisition profit, acquisition date, fair value of the net assets were 9,400, reporting date net asset value of the subsidiary 9,500. So the increase in the net assets are 100. So this post acquisition net asset increase of the subsidiary, out of that 60% belongs to the parent company and the 40% belongs to the whom? Non-controlling interest. Okay, out of the post acquisition net assets, that is from 30th September 2019 to 31st December 2019, 3 months period. So the net asset value has gone up by 100. Out of that, 60% to the parent company and 40% to the NCI. So the parent's 60% you take to the where? Consolidated retained earnings. I can say with regard to Teak post acquisition. With regard to Teak post acquisition, how much? 100 into 60%. Why 60%? 25 plus 35, altogether 60%. So 100 into 60%. Then out of this 100 post acquisition, 40% belongs to whom? Non-controlling interest. Allocate that 40% to the working number 4 balance sheet NCI value. So you can say Teak subsidiary post acquisition. Post acquisition 100 into 40%, which comes to 40. Okay, right. We have calculated the goodwill. We have taken the figures to the NCI, post-acquisition profits. We have taken the post-acquisition to the consolidated retained earnings. Working number 6 done. Working number 7, associate was derecognized. Actually, associate balance would be ultimately how much? It has to be 0. Okay, this has to be 0, no balance. Then the profit attributable to NCI will be calculating later. And also we have completed share of associate profit after tax and share of associate other comprehensive income. Then you also need to consider one more thing, that is, remember in part 4 we calculated the what? Disposal profit in the group accounts with regard to the disposal of small limited. And remember, this disposal has been taken place on when? Very important, look at the disposal date. Disposed the entire holding of small limited on when? 1st January 2019. That means at the beginning of the current financial year. Now what you need to do is this consolidated profit of disposing the subsidiary to be included into the where? Consolidated income statement. But you have to look at one thing. If you look at the income statement, within the income statement, under the other income, there is a profit of, there is a income of 3,800. What is this? This is actually the gain made by the parent company in their individual financial statements. Okay, gain made by the parent company in their individual financial statements. Okay, so if you look at the question, under the so in pilot paper, so under the heading, or in my tute, under the heading disposal of small limited, that is there in the pilot paper as well. 1st January 2019, Pinnacle sold all holding in small limited for 5,400 million. As small limited is not related business with Pinnacle PLC's core business. Accordingly, 3,800 million gain was recognized in the income statement of Pinnacle PLC. That is actually the difference between the sales proceed. What is the sales proceed? 5,400. And what is the initial investment in the individual financial statements of the Pinnacle? Investment in small, 1,600. So what is the difference between 5,400 and 1,600? 3,800. You buy the investment at, you invested 1,600 in subsidiary, you disposed the subsidiary after 1 year with at a proceed of 5,400. So the profit is how much? The difference 3,800. That is included in the income statement of the Pinnacle, individual income statement of the Pinnacle. Now when I am preparing the consolidated financial statements, what you need to include is not the individual profit but the consolidation profit. In my introductory video also I have mentioned this point. Okay, so what I need to do is I have to take out the profit in the individual P&L of the Pinnacle, which is 3,800, take that out, and I have to include the profit in the group accounts. What is the profit in the group accounts on this disposal? We have calculated earlier in part 4, 1,400. I am going to include 1,400 here and take out 3,800. Okay, take out 3,800 and include 1,400. Okay, you can give the this is the group profit. This is the group profit. Okay, no space there, so rather than saying group profit, can I say adjustment number or the question number 4? Then it's easy for you to refer. So from the part 4, you derive this answer. Okay, but if you have the space when you are writing down, you can say the group profit 1,400. Okay, so for the reference I have included that as part 4 answer, then you know what it is. Right, then just check whether you have considered everything with regard to the balance sheet. Just double check whether you have taken everything. It seems that we considered all the items and the adjustments have been made. Now I can actually complete all the statement of financial position related workings are now complete. I can even complete the balance sheet. Okay, so let's take the numbers to the balance sheet. First of all, I can take the I can actually complete the workings relating to the balance sheet, right? So so the goodwill, I have taken the number. NCI, I can take the total here. I can take the total relating to NCI. How much? 4,600 plus 40, 4,640. I am taking that to the balance sheet. Non-controlling interest, working number 4 here, 4,640. Okay. Then the consolidated retained earnings, I can again take the total here, 47,160, 47,160. Working number 5, consolidated retained earnings, 47,160. Okay, right. Then I can complete the working number 6 as well, consolidated other components of equity. Okay, how much is the figure? 1,853 minus 975, 878. You take 878 here. Okay, 878 here. Clear? Then investment in associate value has become 0. Okay. Then the working number 8 and working number 9 are, working number 8, 9 and 10 are not relating to the statement of financial position. Those are relating to the statement of profit or loss and the other comprehensive income. Okay, right now I'll take the assets and the liability values as well. So PP&E, how much is the total? 58,459 plus 7,600 plus 800. How much? 66,859. Okay. So here you see ultimately the value has to be 0. 7,020 minus 975, fair value, cumulative fair value gain has been deducted. Then you have deducted the cost of investment of the 25%, 2020. You also deducted the cost of investment of 35%, 4,025. Okay. So it has to be 0, you see, it is 0. Now the goodwill we have taken. Inventory, I would say 32,236 plus 400, 32,636. Trade receivable 13,042 plus 700, 13,742. Other current assets 172 plus 350, 522. Cash and cash equivalents 7,721 plus 750, 8,471. Okay. If I take the total, okay, so I would say total assets. Total assets. What is the value of the total assets? Total of everything. 124,330. 124,330. Then under the equity, stated capital 16,718. Retained earnings, consolidated retained earnings 47,160. Consolidated other components of equity 878. Non-controlling interest 4,640. We have taken everything. Then the long term debt under the non-current liabilities 24,420. Current liabilities, trade payable 11,970 plus 820, 12,790. Current portion of the long term debt is how much? 15,376. Finally, other current liabilities 2,068 plus 280, 2,348. Then I can take total equity and liabilities. Total equity and liabilities. How much? Take the answer. Take the total equity from here. Total equity and total non-current liabilities and total current liabilities. 124,330. You see the balance sheet or the statement of financial position is balanced. Okay. 124,330. Now what we need to complete is only the income statement. Even in the income statement I have completed all the workings. Only thing is, after deriving the group profit and the group total comprehensive income, I need to attribute that to the equity holders of the parent and to the non-controlling interest. Okay. So but before moving to that, let me complete the income and the expenses of the consolidated income statement as well, income statement and other comprehensive income. So how much is the sales figure? You can take the numbers. How much? 150,738 plus 800 multiplied by 3 divided by 12. How much is the answer? 150,938. Cost of sales. Okay, cost of sales. How much? It has to be a negative figure. So I am taking the figures minus within brackets. 109, 285 plus 380 multiplied by 3 divided by 12. So close the bracket. How much? 109,380. So then revenue minus the cost of sales, gross profit comes to 41,558. Okay, 41,558. Operating expenditure, again it has to be a minus figure. So minus, open a bracket, 37,178 plus 20 into 3 divided by 12. 37,183. 37,183. Then profits from the operations are 41,558 minus 37,183. How much is the value? 4,375. 4,375. Then other income is equal to 3,800 plus 355 minus 3,800 plus 1,400. How much? 1,755. 1,755. Okay. Other expenses and the losses, 2,582. Okay, negative 2,582. Then adding all these things, I can derive the profit before tax, that is 4,375 operating profit plus the other income 1,755 minus the other expenses 2,582 plus share of profit after tax of the associate 60. You are getting a profit before tax figure of how much? 3,608. 3,608. Again, after that you have the income tax expenditure is equal to minus, it has to be a minus figure, expenditure 883 plus 80 into 3 divided by 12. How much? 903. Okay, income tax expenditure 903. So the profit for the year, profit before tax plus, or the profit before tax minus income tax 903, you are getting a profit after tax figure, or the profit for the year 2,705. 2,705. So this is the final profit for the year of the Pinnacle Group. Okay, so this is actually the, so if I correctly mention the name, this has to be now not Pinnacle PLC. It has to be what? Pinnacle Group. It's the consolidation accounts, right? Pinnacle Group Consolidated Statement of Financial Position as at 31st December 2019. Similarly, income statement also, the name has to be not Pinnacle PLC, Pinnacle Group, as it is group accounts, right? Small correction. Okay, profit we derive. Then the other comprehensive income, revaluation gain, take the numbers, is equal to 300 plus 80 into 3 divided by 12, 320, right? 320. Then the fair value gain of the equity instrument, you had 555, you reverse entire 555, because when it comes to the consolidation accounts, you can't keep the fair value gains of the investment in subsidiaries. That has to be reversed in the consolidation accounts. So you reverse, so this is 0. So 320 plus 15, so the total of the other comprehensive income items, 320 plus 0 plus 15, how much? 335. This is actually total other comprehensive income. This is the profit for the year 2705. Total other comprehensive income is 335. Then the total comprehensive income is the addition of profit for the year plus total other comprehensive income. 2705 plus 335, 3040. Okay, 3040. Then the final thing is we need to allocate this profit for the year 2705 and the total comprehensive income, which is how much? 3040 into the equity holders of the parent and to the non-controlling interest. So for that we have done the working number 8. So we need to calculate what is the profit attributable to non-controlling interest. Thereafter we need to calculate what is the total comprehensive income attributable to non-controlling interest. So first of all, let's calculate the profit attributable to non-controlling interest. Now in this scenario, in the income statement, what we consolidate is the Pinnacle and Teak. Even the Teak we consolidate only for the what? Last 3 months. Then out of the last 3 months profit of Teak, 60% belongs to the parent company and 40% belongs to the NCI. So you can easily calculate the profit attributable to NCI, take the last 3 months profit of Teak and out of that allocate how much? 40%, simple. So with regard to Teak, how much is the total profit? If you go to the individual profit or loss of Teak that is given in the question, how much is that? 320. Okay, 320. Out of that you have to take last 3 months multiplied by 3 divided by 12, because it was a subsidiary only in the last 3 months. Okay, first 9 months it was an associate. If it is an associate, there is no allocation to the non-controlling interest. So non-controlling interest is there only when the Teak is a subsidiary. So last 3 months profit, so the total profit 320, out of that last 3 months profit 3 upon 12 into 40% to the non-controlling interest, simple. So take the number here, 320 into 3 divided by 12 into 40%. How much? 32. So the profit attributable to NCI is 32. I can easily take that number here. Profit for the year attributable to, I would say non-controlling interest, working number 8. I can easily take the number here 32. Profit attributable to non-controlling interest. Then if the profit attributable to non-controlling interest is 32, what is the profit attributable to the equity holders of the parent? What is the total profit for the year? What I have highlighted in yellow, 2705. Out of that you allocate 32 to the non-controlling interest. That means the remainder to the equity holders of the parent, which is 2705 minus how much? 32, this figure. You got what I say, right? So the total profit for the year 2705. Out of that you allocated 32 to the NCI by this working. So this is the working. Okay, through this working it has been allocated to the NCI. Then if 32 was allocated to the NCI, the remaining profit out of 2705 minus 32 is allocated to the profit attributable to equity holders of the parent. That is parent's entire profit plus subsidiary last 3 months profit into how much? 60%. Okay, roughly. So the remainder, so the balancing figure, you are taking always equity holders of the parent profit allocation as the balancing figure. Right, done. Then finally I also need to allocate total comprehensive income. So what is the total comprehensive income? 3040, what I have highlighted in this green, 3040. That also to the equity holders of the parent and to the non-controlling interest. So if I calculated the profit attributable to NCI is 32, then if I can calculate other comprehensive income attributable to NCI, then I can take easily the total comprehensive income attributable to NCI, because total comprehensive income attributable to NCI is equal to profit attributable to NCI and the other comprehensive income attributable to NCI. So now if you look at again with regard to non-controlling interest, you always need to look at the subsidiaries profit or loss and OCI, because non-controlling interest is there with the subsidiary, not with the parent. Now if you look at the subsidiary other comprehensive income, you have other comprehensive income item 80. Now out of this 80 subsidiary TEEC, it is a subsidiary only in the last 3 months. You have to take 80 into 3 upon 12, because allocation to the non-controlling interest is taken place when it is a subsidiary. It was a subsidiary only in the last 3 months. So you have taken 80, the total on revaluation of PP&E 80 into 3 upon 12 into how much? Into 40% to the NCI. 80 is the total gain on revaluation last 3 months, 3 upon 12. Out of that 40% to the NCI. How much is that? Is equal to 80 into 3 divided by 12 multiplied by 3 divided by 12 into 40%. How much? 8. So the other comprehensive income attributable to NCI is 8. Then I can easily take what? Total comprehensive income attributable to NCI. That is the total of profit attributable to NCI and other comprehensive income attributable to NCI, which is how much? 40. That is 40. Right. Then here I am taking total comprehensive income attributable to NCI coming from working number 8 equal to 40, this figure 40. Then how much is the equity holders of the parent? The balancing figure, because total comprehensive income here, what I have highlighted in green is how much? 3040, and out of that you have allocated 40 to the non-controlling interest, remainder to the equity holders of the parent, which is how much? 3040 minus 40, that comes to 3000. That comes to 3000. Yeah. So I can make these figures, important figures, bold. Okay, total comprehensive income bold, total other comprehensive income bold. Okay, for you to see the figures. This is also bold. Profit bold. Yeah. And make the gross profit bold. Yeah. This is bold. Okay, right. So all the figures in the consolidated profit or loss and the other comprehensive income is also done. On the other hand, balance sheet we have already completed. Okay, with that, okay, it was a long question and good question to understand a lot of consolidation adjustments like step back position and the disposal where control is lost. So I followed the step-by-step approach. So I explained to you all workings to be required in the statement of financial position and the statement of profit or loss and the other comprehensive income. Hope you understood that. So a similar type of a question, okay, with additional adjustments, like examiner can test a scenario. This is a scenario where the control is lost. Maybe in your exam you have a scenario, even though the disposal is taken place, control is not lost, control is retained. Example, parent had 100% investment in a subsidiary, parent disposed only 40%. That means after the disposal event, parent is having 60%. Okay, so there is a disposal, but control is retained. This is called as control to control scenario. Then the accounting is different to the scenario where the control is lost. Okay, so with that we are done with the question as well as all the questions in the pilot paper.